Is the financial system's plumbing about to burst, or are we just seeing a necessary market correction?
Former New York Fed official Joseph Wang and Bloomberg chief economist Anna Wong say the warning lights are flashing red. Along with analysts Nick Gerli and Matt DeWolf, they are exposing the hidden risks in everything from shadow banking to the S&P 500.
We have utilized advanced AI to compress hours of these complex expert discussions into just a few minutes of actionable insights, saving you time without sacrificing depth.
First, Joseph Wang reveals why the Fed's latest moves might trigger a liquidity crisis sooner than you think. Also, stay tuned to find why the 5,000 level is the ultimate battleground for stocks. Just a quick reminder, this content is for educational purposes only and is not intended as investment advice.
Today we are looking at the latest market analysis from Joseph Wang, also known in the industry as the Fed guy.
Joseph Wang spent years on the inside at the New York Fed's open market desk, so he knows where the bodies are buried in the Treasury market.
Wait, the open market desk? Is that like a trading floor for the government?
Pretty much. He was actually one of the guys pushing the buttons on multi-billion-dollar trades to keep the economy stable.
Which means when he talks about market liquidity, we should probably listen.
Joseph Wang focuses on what he calls the plumbing, the complicated way money moves between banks and the Fed.
I'm sorry, plumbing? Are we talking about leaky faucets or interest rates?
It is a metaphor. If the plumbing clogs, the whole financial system breaks down, and that is what Joseph Wang tracks.
Exactly. He connects the dots between boring Fed spreadsheets and why your mortgage rate just jumped.
Okay, so he is like the guy who tells us if the pipes are about to burst. Got it.
Joseph Wang's main argument is that the Fed's QT, or quantitative tightening, is finally starting to dry up the market's extra cash.
He notes that for years the system was overflowing with liquidity, but the Fed is now pulling that back at a steady clip.
Hold on. If the Fed takes the money back, doesn't that make it harder for regular people to get loans?
Spot on. Joseph Wang warns that as that cash disappears, volatility in the stock market usually goes way up.
So the party is over, and the Fed is taking away the punch bowl.
Great. I always arrive at the party right when they start cleaning up.
A huge part of Joseph Wang's concern is the sheer amount of debt the government is issuing right now.
He explains that the Treasury is flooding the market with bonds to fund the deficit, but there are not enough buyers to keep prices stable.
Wait, if there are more bonds than buyers, what happens to the price?
The price of the bonds drops and yields go up. It is basic supply and demand.
And Joseph Wang thinks this imbalance could lead to a sudden spike in interest rates that catches everyone off guard.
So the government is basically over-leveraged, and we are the ones who might pay for it through higher rates.
Joseph Wang also points to the RRP, the Reverse Repo facility, which has been a massive cushion for the market.
That cushion is almost gone. It has dropped from over $2 trillion to nearly zero.
$2 trillion to zero? That sounds like a big deal. What happens when it hits zero?
Joseph Wang says that's when the real QT begins. The easy money is gone, and the Fed will have to start draining actual bank reserves.
Which means banks might get stingier with their lending.
So we are moving from a soft cushion to a hard concrete floor. Fun.
Despite everyone hoping for a drop, Joseph Wang argues that inflation is staying sticky in the service sector.
He points out that while goods prices might be falling, the cost of labor and services is still rising too fast.
Sticky inflation? Is that why my car insurance and haircuts keep getting more expensive?
Exactly, those are services. Joseph Wang notes that as long as wages stay high, the Fed can't really lower rates.
So the Fed is stuck between a rock and a hard place.
And we're the ones getting squashed in the middle.
Joseph Wang predicts that the Fed will keep interest rates higher for a lot longer than the stock market is currently pricing in.
The market is dreaming of rate cuts, but Joseph Wang thinks the Fed is worried about inflation bouncing back if they pivot too early.
So all those people waiting for lower mortgage rates might be waiting a while?
Possibly through the end of the year. He doesn't see a reason for the Fed to rush into cuts while the labor market is this strong.
Basically, expect the pain of high rates to linger.
Note to self, don't look at my credit card interest rate today.
However, Joseph Wang does see one possible escape hatch. The Fed might slow down their QT program by mid-year.
He predicts they'll do this to prevent a repeat of the 2019 repo market crisis, where the system literally ran out of cash.
A liquidity crisis? That sounds like a heart attack for the economy.
It is. Joseph Wang thinks they will taper the drain to make sure the banking system stays liquid.
So they'll stop pulling the money out as fast, just to keep the lights on.
Well, a slow drain is better than a clogged pipe, I guess.
Joseph Wang suggests that investors should keep a close eye on the reverse repo levels every week.
If it hits zero, that is your signal that the market's safety net is officially gone.
Where do I even find that? Is there an app for reverse repo tracking?
You can find it on the St. Louis Fed's website. It is called FRED data.
When FRED shows zero, expect a bumpy ride in the S&P 500.
Lastly, Joseph Wang recommends watching 10-year and 30-year Treasury auction results.
If the bid to cover ratio is low, it means big investors aren't buying, which will push rates even higher.
So if the big guys aren't buying government debt, I should probably be careful with my own investments.
Exactly. It is the ultimate canary in the coal mine for the broader market.
As Joseph Wang says, follow the plumbing and you'll see where the money is going.
Alright, I'm officially a financial plumber. Hand me my wrench.
Today, we're digging into a pretty alarming report from Nick Gerli, the CEO of Reventure Consulting, about the current state of the U.S. mortgage market.
Nick's been tracking the data for years, and he's sounding the alarm on what he calls the biggest mortgage collapse in history.
Wait, biggest in history? Like worse than 2008? How is that even possible?
That's exactly what we're looking at. Nick's analysis points to a massive shift in who actually owns our mortgages, and it's not who you think.
Nick Gerli highlights that it's no longer the big commercial banks like Chase or Wells Fargo dominating the scene.
Right, he notes that shadow banks, non-bank lenders, now control a huge chunk of the market.
Hold on, shadow banks? That sounds like something out of a spy movie. Are they legal?
Totally legal, but Nick's point is, they don't have the same safety nets as traditional banks, which is where the danger lies.
Nick Gerli's core thesis is that the mortgage market has been taken over by non-bank lenders, originating over 70% of loans.
And unlike traditional banks, these companies don't have customer deposits to fall back on when things get hairy.
So if they don't have our savings accounts, where are they getting the money to lend out for houses?
They borrow it. They use short-term lines of credit, which Nick explains makes them incredibly vulnerable to rising interest rates.
Exactly. They're basically middlemen with a lot of debt and very little padding. Nick points out that because these aren't banks in the traditional sense, they aren't regulated the same way.
They don't have the massive capital reserves that the Fed requires of the big players.
Wait, so they're lending out hundreds of billions without a rainy day fund? That sounds like a recipe for disaster.
According to Nick, it's not just a recipe, the oven is already preheated.
When mortgage volumes drop, these companies start burning through cash just to keep the lights on.
Nick Gerli highlights a staggering drop in mortgage demand, down 50 to 60% from the peak.
With high rates, nobody's refinancing and fewer people are buying, which means these non-banks have no new money coming in.
So their entire business model just stopped. How are they still in business?
Many of them aren't doing well. Nick mentions that several have already gone bankrupt or are being sold for pennies.
He's seeing a massive consolidation because the smaller players just can't survive this drought.
One way these lenders survive is by selling mortgage servicing rights, or MSRs.
Okay, jargon alert. What on earth is a mortgage servicing right?
It's basically the right to collect your monthly payment and take a small fee. Nick says lenders are selling these off just to get quick cash.
But once they sell those rights, they lose that steady stream of income. It's like selling the golden goose to buy one last meal.
So, it's a desperate move to stay alive today, but it kills their future. Got it.
Nick discusses Ginnie Mae, which is the government agency that guarantees many of these loans.
If these non-bank lenders fail, Ginnie Mae is the one left holding the bag for the payments to investors.
And when we say government agency, we really mean taxpayers, right?
Exactly. Nick's concern is that the scale of this collapse could eventually require a federal intervention.
He notes that Ginnie Mae has already had to set up special liquidity facilities just to keep these lenders from imploding.
So the biggest collapse isn't just a clickbait title, it's a systemic risk.
Nick Gerli predicts a significant wave of bankruptcies among mid-sized mortgage lenders over the next 12 to 18 months.
This will likely lead to a credit crunch, where it becomes even harder for the average person to get a loan.
Wait, so even if I have good credit, I might not be able to get a mortgage because the lenders are gone.
That's the risk. Fewer lenders mean less competition and much stricter requirements.
Nick believes this will keep the housing market frozen, even if the Fed starts cutting interest rates.
Finally, Nick sees this leading to a drop in home prices as distressed assets hit the market.
He's particularly looking at areas where non-bank lending was most aggressive, like the Sunbelt.
So, silver lining? Maybe houses will finally get cheaper for the rest of us?
Possibly, but Nick warns it won't be a fun process. A price correction driven by a financial collapse is usually pretty messy.
It's the classic, be careful what you wish for scenario.
Nick Gerli suggests watching the delinquency rates for FHA and VA loans very closely.
These are the types of loans most often held by these vulnerable non-bank lenders.
So if more people start missing payments on those, it's a sign the lender's house of cards is falling.
Exactly. That's the first domino Nick says we should be looking for. He also recommends keeping an eye on the big public players, like Rocket Mortgage and United Wholesale Mortgage.
Even though they're the giants, their earnings reports will tell us if the entire industry is starting to breathe underwater.
Got it. So check the big guys to see how bad the little guys are suffering.
Precisely. Thanks to Nick Gerli for the data-driven reality check on this one.
It's definitely time to stay cautious and keep an eye on the data.
Today we are breaking down a major shift in the economic outlook from Anna Wong, the chief U.S. economist at Bloomberg Economics.
Anna has a massive pedigree. She is a former official at both the Federal Reserve and the Treasury. When she speaks, Wall Street listens.
Wait, so she used to be on the inside at the Fed and the Treasury? That is a serious resume.
Exactly. And for a long time she was actually more optimistic than most. But in her recent discussion with Adam Taggart, that optimism has faded.
It is a big deal. She was one of the few voices calling for a soft landing early on, but now she is waving a yellow flag.
She is seeing cracks in the foundation that most people are still ignoring because they are looking at lagging data.
Lagging data? You mean like looking in the rearview mirror while driving toward a cliff?
That is exactly the metaphor Adam Taggart used. We're going to dive into why Anna Wong thinks the road ahead is getting bumpy. Anna Wong's core thesis is that the buffer that kept us afloat is gone. She notes that excess savings for the bottom 80% of households have vanished.
Right. During the pandemic, everyone was flush with cash, but Anna points out that those bank accounts are finally tapped out.
80%. So basically everyone except the super rich is out of extra cash.
Pretty much, and without that cushion, consumers are much more vulnerable to even small economic shocks.
It means the YOLO spending spree we have seen is hitting a brick wall.
Well, there goes my plan for a luxury vacation. Thanks for the buzzkill, Anna.
For a year, people asked why high interest rates weren't hurting the economy. Anna Wong says they are finally starting to bite.
She explains that there is a long lag time, sometimes 18 to 24 months, before rate hikes really cause pain.
Hold on, 18 months. So the hikes from last year are just hitting us now?
Bingo. Anna believes we are just now entering the danger zone where the Fed's actions actually start slowing things down.
It is like a slow-acting poison. You feel fine for a while, and then suddenly you don't.
That is a terrifying analogy, but it definitely makes the point.
Anna Wong is watching the unemployment rate closely. It moved from 3.4% to 3.9% recently.
That move is significant because of the Sahm Rule, named after Claudia Sahm, which says when the 3-month average rises 0.5%, you are in a recession.
Wait, 0.5% doesn't sound like much. Is that really enough to call a recession?
Historically, yes. Anna notes that once that momentum starts, it almost never stops until it hits much higher levels.
And she told Adam Taggart that this momentum is what the Fed is failing to account for right now.
So if it starts snowing, we are basically guaranteed a blizzard.
Anna also highlights that it is not just about layoffs. She sees a massive drop in the hiring rate and the number of hours people are working.
Right. Companies aren't firing everyone yet, but they have stopped hiring, and they are cutting back on shifts.
So you still have a job, but your paycheck is smaller because you're working fewer hours?
Exactly. Anna argues that this is the first stage of a labor market breakdown that eventually leads to the big layoffs.
She calls it a quiet cooling that is about to get a lot louder.
I think I prefer the quiet version, honestly.
Another red flag from Anna Wong's data is the spike in delinquencies for credit cards and auto loans.
They are hitting 10-year highs, particularly for younger borrowers and those in lower income brackets.
Wait, 10-year highs? So people are struggling more now than during most of the last decade?
Yes, and Anna points out that this usually happens right before the broader economy starts to contract.
It is a sign that the cost of debt is finally overwhelming the average person's ability to pay.
So the death by 1,000 interest rate cuts is actually happening.
So what is the timeline? Anna Wong told Adam Taggart that she expects a recession to be officially underway in the first half of 2024.
She thinks the data will finally catch up to the reality on the ground by then, and the soft landing narrative will crumble.
The first half of 2024, that is, like right now or very soon.
It is imminent. Her models suggest that the cumulative weight of the Fed's hikes is just too much to avoid a contraction.
She is basically saying the plane is descending and there is no runway left.
Great. I'll just tighten my seatbelt and pray for the best.
If a recession hits, Anna predicts the Fed will have to pivot hard and cut rates by at least 125 basis points.
That is a big move. It would mean they realize they stayed too tight for too long and have to scramble to save the economy.
Wait, 125 basis points? Is that like 1.25%?
Exactly. It sounds small, but in the world of central banking, that is a massive emergency level of cutting.
But Anna warns that by the time they start cutting, the damage to the labor market might already be permanent.
So it's like calling the fire department after the house has already burned down.
Anna Wong's advice is to stop looking at the headline numbers and start watching the real-time data like weekly jobless claims.
She also suggests watching credit spreads. If lenders start getting nervous about who they lend to, that is a huge warning sign.
Jobless claims and credit spreads. Got it. I'll add those to my daily doom scrolling list.
It is better to be informed than surprised. If jobless claims start ticking up consistently, Anna says that is your signal to get defensive.
Finally, the takeaway from her talk with Adam Taggart is that this is not the time to be chasing risky assets.
Anna implies that having some dry powder, cash, and moving into defensive sectors might be the smartest move for the next 12 months.
So, basically, stop gambling on meme stocks and start acting like an adult with my money.
That is a blunt way to put it, but Anna Wong's data definitely supports a safety-first approach right now.
Better to miss a small rally than to be wiped out by a major crash.
Fair point. Safety first. Luxury vacations, maybe in 2025.
Today, we're diving into the latest market breakdown from Matt DeWolf over at Trade Brigade. He's sounding the alarm on some pretty nasty charts.
Matt's been tracking the technical levels on the S&P 500 and the NASDAQ, and let's just say the bulls are sweating.
Wait, sweating? Are we talking a little nervous, or hide your money in the mattress nervous?
Matt thinks we're looking at a structural shift, not just a little dip. It's about those key support levels finally giving way.
Exactly. Matt DeWolf is looking at the price action and seeing patterns that haven't shown up in months.
So, is this the market crash everyone keeps putting in their YouTube titles? Or is Matt actually seeing something real?
That's what we're here to find out. He's looking at the hard data, not just the hype.
And the data says the trend is changing. Buckle up.
Matt DeWolf's main thesis is that the massive upward channel we've been in for months is officially broken.
Right, he pointed out that once we lost that bottom trend line, the floodgates opened. It's a classic technical breakdown.
Hold on, an ascending channel? In English, please.
Think of it like a staircase. We were walking up steady, but Matt says we just slipped and fell through the steps.
And now we're looking for where the floor is. Matt isn't convinced we found it yet.
Great, so we're basically in freefall until Matt says otherwise?
Matt is laser focused on the 5,000 level on the S&P 500. He calls it a psychological battleground.
If that level fails to hold, Matt thinks we could see a quick slide down to 4,800 or even lower.
Wait, why 5,000? Is it just because it's a nice round number?
Precisely. Matt explains that big round numbers act like magnets for traders. Everyone is watching that exact spot.
And if everyone watches it and it breaks, the panic selling usually kicks in.
So 5,000 is the line in the sand. Got it.
Matt DeWolf also noted that the Nasdaq is looking even weaker than the S&P. Big tech is taking a beating.
Yeah, he's seeing a lower high pattern on the daily charts, which is basically the opposite of what you want to see if you're an investor.
Wait, a lower high? That sounds like a fancy way of saying things are getting worse.
Exactly. It means every time the market tries to bounce back, it fails at a lower price than the time before.
Matt calls that a sign of exhaustion. The buyers are just running out of steam.
So the tech giants are basically gasping for air right now.
Matt pointed out that the volume on these down days is significantly higher than on the bounce attempts.
That's a huge red flag. It means big institutional money is likely hitting the exit buttons.
So it's not just a few people panicking. It's the big players leaving the room.
According to Matt's analysis, yes. When the smart money sells with high volume, you usually want to pay attention.
He's not seeing any buy the dip conviction yet. It's mostly just sell the rip.
I'll stick to holding my breath for now then.
If 5,000 breaks, what's Matt's next target?
He's looking at 4,800. That was a previous area of major resistance that should now act as support.
Wait, 4,800. That's a huge drop from where we were.
It's about a 4% move from the 5,000 level. In a correction, that can happen fast.
Matt warns that if we don't hold there, the conversation changes from a correction to something much uglier.
Let's hope 4,800 has some strong glue.
Matt also mentions we might see a brief rally, but he's calling it a potential dead cat bounce.
Right? A temporary recovery that just tricks people into buying right before the market drops again.
A dead cat bounce? That sounds gruesome. Why do traders use these names?
The saying is that even a dead cat will bounce if you drop it from high enough. It doesn't mean it's alive.
Matt's advice is to watch for lower highs on that bounce. If we can't clear previous peaks, the downtrend stays alive.
So don't get excited about a green day until Matt gives the thumbs up.
So what's the actionable move based on Matt's review?
Matt is suggesting patience. Don't try to catch a falling knife. Wait for the market to actually prove it's found a bottom.
So no buying the dip today? My finger was hovering over the button.
Matt would tell you to wait. He wants to see a higher low and increasing buy volume before jumping back in.
Preserving capital is the name of the game right now. Matt's all about playing defense when the charts look like this. He also recommends keeping an eye on the VIX, the volatility index.
If the VIX stays elevated, the swings are going to remain violent. Matt looks at daily closes to confirm if levels are holding.
The VIX? Is that like a thermometer for market fear?
Exactly. When it's high, fear is high. Matt uses it to gauge when the panic might be peaking.
Check out Matt DeWolf's full breakdown on Trade Brigade for the specific candle patterns he's watching tonight.
I'm going to go watch some calming ocean videos and wait for the VIX to go down.
Today we are diving into a report from Nick Gerli at MHFin about the housing market in OSS 10, Texas.
Nick has been tracking the data closely, and what he is seeing in OSS 10 is nothing short of a total market shift.
Wait, OSS 10? I thought everyone was moving there. Is the party over already?
That is exactly what Nick is digging into. It looks like the tech-fueled boom is hitting a very messy wall.
Nick Gerli points out that inventory levels in some parts of OSS 10 have exploded by over 300%.
300%? That is like going from one house for sale to a whole neighborhood overnight.
Basically, yes. Nick says the speed of this collapse is what makes it so bizarre compared to other cities.
It is a case study in what happens when a red-hot market suddenly runs out of buyers.
Nick Gerli's thesis is that OSS 10 is the canary in the coal mine for the national housing market.
Right? Because the supply has skyrocketed so fast that sellers are tripping over each other to get out.
So if there are 300% more houses, prices have to be tanking, right?
They are certainly dropping. Nick notes that the balance of power has completely shifted from sellers to buyers.
It is a massive supply shock that nobody saw coming 2 years ago.
I guess those all-cash offers from 2021 are a distant memory now.
According to Nick's analysis, it is not just about too many houses, it is about nobody being able to afford them.
With mortgage rates hovering around 7%, the monthly payment on an OSS 10 home has doubled for most people.
Wait, doubled? Who can actually afford that? No wonder people are staying away.
Exactly. Nick explains that the affordability ceiling has been hit hard.
So you have record supply meeting record low affordability. Not a great combo.
Sounds like a recipe for a very expensive disaster.
One of Nick Gerli's biggest points is the new construction trap. Builders just kept building even as demand died. And
Nick shows that in suburbs like Pflugerville and Round Rock, builders are sitting on thousands of unsold homes.
Hold on, Pflugerville? That is a real name? Anyway, are they just going to leave them empty?
They are trying to offload them with massive incentives, like buying down mortgage rates, but Nick says it is not enough.
It is a game of chicken between builders and the market, and the builders are losing.
So if I want a new house in OSS 10, I should probably wait for the everything must go sale.
Nick Gerli also highlights that the big Wall Street firms that were buying up OSS 10 are gone.
Yeah, those institutional buyers accounted for a huge chunk of the boom, but now they are net sellers.
So the big money is running for the exits. That cannot be good for regular homeowners.
It is not. When the big players stop buying, the floor falls out from under the prices.
Nick says this investor exit is a primary reason the collapse feels so sudden.
It is like the cool kids leaving the party and everyone else realizing there is no more music.
Nick's data shows that luxury condos in downtown OSS 10 are seeing some of the steepest cuts.
Some of those units are being listed for 20% less than they were a year ago, and they still aren't selling.
20%? On $1 million condo, that is $200,000.
Exactly. Nick Gerli points out that the work-from-home crowd that fueled this is being called back to the office.
So the dream of living in a glass tower in OSS 10 is losing its luster for a lot of people.
Turns out you can only eat so much expensive barbecue before you miss your old office cubicle.
So what is next? Nick Gerli predicts another 10 to 15% drop in prices before we hit bottom.
And that is a conservative estimate. If unemployment ticks up, it could be even worse.
Wait, another 15%? My house is already worth less than I paid for it in some of these scenarios.
Nick says we are only halfway through the deleveraging process for OSS 10.
Basically, the bubble is still deflating. It hasn't popped and disappeared yet.
Great, so the crash is more like a slow, painful leak.
Nick Gerli also expects the market to stay flat for a long time, maybe even years.
The days on market statistic is climbing. It is taking months to sell a house now instead of days.
Months? I remember when houses were sold before the sign even hit the grass.
Nick says those days are over. We are moving into a grind-it-out market.
It is a return to reality. The OSS 10 anomaly is finally normalizing.
Normalizing sounds boring, but I guess boring is better than losing 15% of your value every year.
Nick Gerli suggests watching the months of supply metric. If it stays high, prices keep falling.
Right, in a balanced market, you want about 6 months of supply. OSS 10 is way beyond that.
So if I see the supply number going down, that is my signal to start looking.
Exactly. Until that number drops, Nick says the buyer has all the leverage. Nick also says to watch the big public home builders. They have to move inventory to keep their shareholders happy.
That means you can find deep discounts if you are willing to buy in the newer suburbs.
So basically, look for the guy in the suit who looks like he's panicking.
In a way, yes. Their distress is your opportunity, according to Nick's analysis.
It is a tough time for OSS 10, but a great time for anyone with a long-term plan and a lot of patience.
Patience? I can do that, especially if it saves me 100 grand.
So let's kick off with Joseph Wang, who warns that the latest moves by the Fed could spark a liquidity crisis sooner than we think.
Exactly. His thesis hinges on the idea that rapid policy changes can catch markets off guard, especially if banks get squeezed.
Wait, so he's saying the folks at the Fed might be miscalculating? That's a big deal.
It really is. If liquidity dries up quickly, we could see a ripple effect across the economy. Now let's turn to Anna Wong. Her core argument is that the safety nets we've relied on are fading.
Right. She's pointing out how previous buffers, like low interest rates, are disappearing, which will make economic fluctuations more pronounced.
So basically, we're walking a tightrope without a safety net. Yikes.
Exactly. Anna believes this will make the next economic shifts much more turbulent, and Nick Gerli presents a stark view on housing. He argues that we're heading towards a perfect storm.
Yes, he's worried about the collapse within the shadow banking sector affecting mortgage markets, which can have severe repercussions.
So, if housing takes a hit, it's not just about home prices, but the entire economy.
Exactly. This intertwines with broader economic stability. Here's an interesting point. Despite their different angles, all three experts agree that we're in for more volatility ahead.
Right, Joseph sees this through the lens of liquidity issues, Anna highlights the loss of economic buffers, and Nick points to housing market instability.
So basically, the consensus is, brace yourselves for a bumpy ride.
Exactly. It's a convergence of risks that's creating a perfect storm. Joseph and Anna both stress how crucial the Fed's decisions are for the market's future.
Correct. Joseph warns that missteps could lead to liquidity dry-ups, while Anna believes the Fed's actions are vital in maintaining stability.
Wait, so they both think that the Fed's moves could make or break this situation?
Absolutely. Their data connects the dots pretty clearly. Interestingly, both Nick and Anna agree on the critical role of the housing market.
Yes, Nick warns of the perfect storm, while Anna notes that its cooling is significant for economic stability.
So if the housing market sneezes, we might all catch a cold.
Exactly. It's a barometer of broader economic conditions. Here's a key point of divergence. Joseph thinks we may face a crisis soon, while Anna believes it will take longer.
Right. Joseph argues the Fed's quick actions could trigger immediate trouble, but Anna sees a gradual weakening.
So one's predicting a flash flood, while the other says it's a slow leak.
Exactly. And both perspectives carry weight depending on how policy unfolds. Another clash here. Nick is focused on the housing market's immediate threats, while Joseph prioritizes liquidity.
Exactly. Nick believes the housing sector is right on the edge, but Joseph is more concerned about banking and liquidity shocks.
So one's looking at the house that's on fire, while the other's worried about the reservoir leaking.
Perfect analogy. Both are valid, just different approaches to imminent threats. Finally, Anna's views on longer economic patterns clash with Nick's urgent housing concerns.
Anna's suggesting we need to look beyond the immediate crisis to understand lasting impacts, while Nick is warning us about urgent dangers.
So it's the difference between yes but and no now.
Exactly. Their commitments are clear, yet they highlight different timelines for action. If you found this exploration valuable, don't forget to hit that like button and subscribe.
We're here to distill insights so you can stay ahead in these turbulent times.
Honestly, all these perspectives saved me hours of digging through articles.
Join us next time for more expert insights to help you navigate the financial landscape.